Today's topic covers the so-called economic indicators. But what exactly are economic indicators? Economic indicators are used to provide insights into the economy, that is, the economic development of a country. With the help of economic indicators, the economic development of a country can be specifically analyzed, allowing for a more accurate and effective assessment. Economic indicators thus constitute an important component of economic research. The information obtained from these indicators is therefore highly relevant for both the government and the population. Economic indicators are generally divided into three different categories: leading indicators, coincident indicators, and lagging indicators. Leading indicators are used to obtain an early assessment of a country's future economic situation. Future investment or financing measures by individual companies, or even the state, can be much better planned with the help of leading indicators. Examples of leading indicators include the stock index. Typically, stocks, or shares in companies, are invested in when a positive future development of the companies is expected. Investors regularly analyze the business performance of companies, leading to an early assessment of the company's future economic situation. A rising stock index, therefore, indicates a future positive corporate outlook and thus a positive economic development. Another leading indicator is the order intake of companies. Full order books, for instance, suggest a positive future business development, which in aggregate positively influences a country's economy. Conversely, empty order books indicate an expected weak economic development. Profit expectations of companies can also be considered a leading indicator. Since companies usually estimate the level of profits in advance, profit expectations lead to an early economic assessment of the companies. Therefore, the economic development of a country can be inferred early on from the profit expectations of companies. Another leading indicator is surveys of companies or consumers. In these surveys, companies or consumers are asked about their personal assessment of future economic development. The results of these surveys can be used to create so-called business climate or consumer climate indices. Positive business or consumer climate indices indicate positive economic development, while negative indices suggest an impending negative economic development. Next, we have the coincident indicators. Coincident indicators help determine the current economic situation of a country. Coincident indicators include, for example, the inventory levels of companies. Low inventory levels generally indicate high current demand, which in turn can be seen as the basis for a currently positive economic development in a country. Conversely, high inventory levels point to weak demand, which can be interpreted as a result of a currently weak economic development. Company revenues are also considered coincident indicators. Since company revenues directly reflect the current economic situation of businesses, they allow for an assessment of a country's current economic development. Another coincident indicator is the household savings rate. The savings rate indicates what portion of income private households set aside or save each month. A high savings rate suggests that private households currently have more money available than is necessary for living expenses, which serves as a coincident indicator of a currently positive economic development. However, the savings rate can sometimes also be understood as a leading indicator and is therefore interpreted differently. Here, a high savings rate suggests a feared weak economic development, which private households are preparing for by setting aside capital. The price level for goods and services in an economy is also used as a coincident indicator. Rising prices can be associated with rising income levels, which suppliers have factored into their pricing, indicating a currently positive economic development of a country. Conversely, falling prices can be associated with falling income levels, which point to a currently weak economic development of a country. Finally, we have the lagging indicators. Lagging indicators reflect the economic development of previous periods. Lagging indicators include, among others, a country's inflation rate. The inflation rate, which is the rate of decrease in the purchasing power of money, is collected with a delay, as the purchasing power of money is compared with previous periods. Therefore, the specific data for the inflation rate are not immediately available and must also be processed, making the inflation rate a lagging indicator. The inflation rate is thus connected with price developments in an economy, which is used to assess a country's economic development. Another lagging indicator is the analysis of private and business bankruptcy filings. Bankruptcies are usually filed when previous measures have been unsuccessful. Filing for bankruptcy is typically the last step after a long economic crisis, which means that the bankruptcy rate reflects the previous economic development of a country and is therefore considered a lagging indicator. The unemployment rate is also considered a lagging indicator. A low unemployment rate, for example, indicates high economic activity in the previous economic period. Since the unemployment rate is reported retrospectively for the period in question, and the data is not immediately available, it is considered a lagging indicator. Many other indicators can be used to assess a country's economic development. In practice, economic indicators are not viewed in isolation, but are combined with other indicators and analyses to obtain reliable assessments of the very complex topic. We hope this video has helped you understand the topic of economic indicators. See you next time and have a good one.